Thank you for tuning into today's lesson. We are going to go over interest rates. This is going to be one of the most important variables that we're going to use in these time value money calculations as we move forward. So the key variables that we're going to use in these time value money calculations are going to be, number one, we need the number of years. That's usually going to be denoted by a capital N. And then we're going to need to know the number of compounding periods per year, usually denoted by a lowercase m. And when we say compounding periods per year, for example, if we have monthly compounding, we'll use 12. So a lot of times it'll just be one because there will be one compounding period per year, but there can be more. And then we have the future value. That's often what we're trying to find depending on the equation, or we may be trying to find the present value. Those two variables are denoted by FV or PV, respectively. And then the subject of today's lesson, of course, is the rate of return or the interest rate that we're trying to find. So what is an interest rate, or how do we think about interest rates? Well, one way of thinking about it is a time preference. So we are trading off money in the present with money in the future, and the interest rate is the kind of the mechanism, it's the plug that will equate the two, present money and future money. When we think about savings, what we're really saying is that anyone who saves is deferring consumption. They are making a choice to not consume their money today, and they are really going to consume that money in the future. So we can think about an interest rate as being the compensation for deferred consumption. And if investors have a very high preference for present money versus future money, then they are going to demand a higher rate of interest. And conversely, if investors have a low preference for present money versus future money, then they are going to demand a lower rate. So we can also think about an interest rate as an opportunity cost. So when we say opportunity cost, we are foregoing some other alternative. And when we think about investment alternatives, we really have to make sure that we are choosing actual comparable alternatives. So we wouldn't say, for example, that a risky real estate investment would be equal to an FDIC insured bank account. We want to think about different alternatives with comparable levels of risk. So how do interest rates factor into these time value money equations? So we're always thinking about the rate of return as the minimal rate that an investor should earn on the investment. So the minimum rate of compensation for risk. And we think first about the risk-free rate. And we say that in nominal terms. The term nominal means that we are unadjusted for inflation. The interest rate is unadjusted for inflation. So that nominal risk-free rate is going to be the highest rate of interest that an investment will yield without bearing risk. And that nominal rate, that's usually the stated rate. That's the rate that you see if you go on bankrate.com, or you look in the paper. Those rates that you see are the rates that banks quote. That's the nominal rate. They're not making adjustments, explicit adjustments for inflation. So the nominal rate in that sense really has two components. It has the expected inflation rate, and then it has the real rate. The real rate is the nominal rate minus the expected rate. So the real rate is the rate of interest adjusted for inflation, whereas the nominal rate is unadjusted for inflation. And in practice, that risk-free rate, that nominal risk-free rate, is going to be the rate on some U.S. Treasury security, so some form of U.S. Government debt. And then the specific Treasury security that we use is going to be based on the term of the investment. So if it's a short-term investment, then we're going to use a short-term Treasury security. If it's a longer-term investment, then we'll use longer-term Treasury security. So it's important to kind of match those terms. So let's think about risk premiums for a second. The nominal risk-free rate is our starting point. It's our baseline. But from there, we need to adjust for the risk of the investment. So anything that's beyond a risk-free investment is going to require some degree of additional compensation. And that's really the key, is we're trying to figure out what that additional compensation is. And when we think about risk in the most general sense is just the possibility of loss. And this is really what financial management is all about in a lot of ways, is trying to figure out the degree of risk in an investment and the relevant rate of compensation that needs to go with that. In the next few lessons, we are going to actually get into some of these time value money calculations, but today we've talked about interest rates. It's going to be very important. Appreciate everyone for watching. If you like what we are putting out, please like and subscribe. We'll see you next time.